Castrol and Gulf Oil are the two largest private sector players in the Indian lubricants market. An increase in oil drainage interval, shift towards EV, and COVID-induced demand disruption have impacted the sector. The end of COVID second wave lockdowns, however, has initiated a recovery cycle in the sector that appears to be picking up speed. Castrol reported better than expected results with revenue jumping 21% sequentially to 1,073 crores on better realization and healthy growth in volumes, while gross margin slipped 40 basis points on raw material costs. Rising international crude oil prices continued to impact the raw material costs, which rose 22% QOQ and 54% YOY. EBITDA margins improved to 230 basis points to 24.5%, aided by employee costs, which remained flat over Q2 CY21. Operationally, sales volume saw an 11% surge over the previous quarter to 50 million litres, and realizations improved to 214.6 per litre, up 8.6% QOQ. PAT came in at 185.9 crores, up nearly 33% sequentially, but lower than last year. Management guided for a capex spend of 80 to 100 crores in the current fiscal year and to maintain similar levels in future. Gulf Oil's revenue saw strong growth of 28% to 534 crores, driven by brisk volume offtake and healthy realization. Despite raw material costs zooming 23% sequentially, gross margin expanded 82 basis points to 41.4%. EBITDA improved sequentially but slipped on a YOY basis. PAT was reported at 59 crores, up 93% QOQ, but down 0.7% YOY. Sales volume saw 20% sequential growth to 33 million litres, while realization per litre grew to 161.7 rupees. Sales volume mix was 85% automotive and 15% from industrial customers. EBITDA per litre stood at 23.4 rupees, lower than the pre-pandemic level of 26 to 28 per litre. Management expects margins to remain stable and 10 to 15 crores capex has been earmarked for FY22. Castrol India enjoys the leadership in Indian lubricants market and a strong brand recognition. Its revenue is almost double of its nearest competitor, Gulf Oil. And while Gulf Oil is growing faster, Castrol still commands a margin differential of at least 10 percentage points. With the return of mobility and COVID recovery gaining pace, all lubricants demand pickup is already evident by the volume offtake and new product launches to cater to BS6 vehicles. The company's focus on entering into agreements in the last 2 quarters, which include Mahindra Choice, MG Motors and GeoBP, lays a pathway to deepen presence and expand multi-channel distribution network, a key component for success in a competitive market. It's already supplying to the largest EV OEMs and hence well positioned to balance any impact from the shift towards EVs. We expect Castrol's volume to grow at a CAGR of 13.7% for the next 2 years, and realization should also see a 7 to 8% growth on a low base of CY20. We forecast an EPS CAGR of 24% for the next 2 years. Gulf Oil continues to recover from COVID blues, and despite adverse base oil prices, it has managed to boost realization and sales volume. It recently launched products aimed at the EV market, which are likely to see gradual growth. It also managed to raise prices of its products and therefore should see margin pressure ease to an extent. Company's EBITDA positive battery business is picking up while gearing up for an opportunity of setting up EV charging infrastructure, which should see some traction in the medium term as EV demand gains momentum. We see Gulf Oil's volume grow 5% annually for the next 2 years, while realizations may grow 6 to 7% in the same period. We forecast EPS CAGR of 17% between FY21 to 23. Crude oil prices rose sharply this year and may see a return towards $80 per barrel next year. Therefore, base oil prices may also see further upmove. Nonetheless, in the last 6 months, both Gulf Oil and Castrol have been able to pass on the rising costs to consumers and should be able to retain current margin levels. Both Castrol and Gulf Oil underperformed the markets, and recent price correction creates a good upside in both of them. Castrol and Gulf Oil are trading below their long-term forward PE multiples. Investors can select Castrol for the long term, while Gulf Oil is a good bet for the medium term.